Thank you to everyone for joining so far. We're just going to give it a little bit longer. I can see the numbers of attendees climbing, so we want to make sure we capture as many people as we can from the start. So we'll be kicking off very soon. Okay, I think the numbers have pretty much plateaued out there, so I'm going to make a start on this one because there's a fair bit to cover. Thank you to everyone for joining the webinar today. My name is Katie Timms. I am our partner in charge of SMSF services here at RSM. This webinar popped up a little bit last minute. We've been getting a lot of queries and conversations around this Division 296 tax, which is the new proposed tax on superannuation balances that exceed $3 million. And we really wanted to kind of, I guess, cover off on, look, break this back down a little bit to basics. What is the tax? What are all of the issues that we've got around it? Maybe start to give people some tools and things to consider as part of this tax. So hopefully you're going to walk away at the end of this with a better understanding of what it is, of how it might apply to you if it does, and what are some of the things you can start to think about. Now, we have actually got one of my wonderful team members online answering questions at the same time. So please do pop any questions that you do have into the chat. She will answer what she can as we go. And then I've got room at the end as well to answer some questions live. If we run out of time, because I get so excited and I'm sharing so many facts and details, we'll make sure to try and address your queries after the webinar as well. But we have got quite a bit of interest in this one. So hopefully we're going to get through everything that we want to. We do also, however, before we start, want to do an acknowledgement of country. We acknowledge the traditional owners of the land and waterways on which we all gather today and pay our respects to elders past, present and emerging. Okay, so what am I actually going to talk about today? Well, I'm going to give everyone a quick overview and just a quick reminder of exactly what this tax is, what it is we're thinking about, how it actually is going to work. I'm going to give you a bit of a current state of play with a little bit of a history lesson and a journey as to how we got here, because we are in a bit of a rush at the moment. This journey, however, did start quite a long time ago, but we've been sitting in quite a period of uncertainty for quite a long amount of time. So I'll give you a little bit of intel as to where we're at with this and where we think it's going to go, and what sort of timeframes we are looking at. I'm then going to really break it down into the finer details. So what are the different steps, to figuring out, does it apply? What's the calculation? How does it impact it? All of the questions that we have been asked over the last, probably month or so since this has really started to gain traction. I'm then going to give everyone some key questions to ask. And this is what I'm sort of telling everyone at the moment is, well, number one, don't panic. Let's not make any rash decisions because there's some really key principles that need to be considered before we actually make any decisions about, well, do we need to take action? What are the costs to take that action? What do we do with it if we choose to take it out? What are the costs associated with that? So, and what are the long-term implications as well, I guess, on your superannuation? So that's what I'm going to go through today. We are recording this session, so if I go too fast, if I use acronyms that you're maybe not aware of, I'll apologise in advance. You will get the opportunity to watch it again, if there's something you missed. But also we really do encourage you to reach out to ask questions about your circumstance because everyone is different. And unfortunately, I wish I was able to give you just a really simple, straightforward, this is what you do, but that doesn't exist in this scenario. There's too many different factors in play. So as much as we all hate when lawyers and accountants say it depends, there's a little bit of that to this, but hopefully what you'll get out of this session is a bit more of a framework for what do you need to start thinking about in all of that. All right, so getting on to the meaty stuff now. So what actually is this tax? We call it's Division 296 of the Tax Act. That's actually what us accountants are going to call it forever. The media is calling a lot of the $3 million super tax, the tax on the super wealthy. What actually is this? It's a tax on earnings for superannuation balances over $3 million. Now, you'll notice that I've put earnings there in inverted commas. That's because as part of this legislation, we have come up with a new definition of earnings. So it is not as simple as just saying what income have you earned? No, we have a new definition of earnings, and that is probably one of the most topical things about this tax is this new definition. Now, just to clarify as well for everyone, it is per member. Okay, not per fund. So if you do have a self-managed super fund that has $3 million, but there's more than one member, great, you may not be impacted by this tax. It is per member. So each individual has to have a balance of more than $3 million for this tax to apply. Now, as I said, there is this new definition of earnings, the thing that we like the least, which is that earnings now for this tax purposes and this tax purposes only. So I've also had a lot of people ask questions around, is this going to apply for other taxes or, anything outside of superannuation? This is just for this tax at this point in time. We've certainly not heard anything different, but it includes unrealized gains. And so what that means is that it is a tax on the movements in market values of investments and assets, not just on income generated, but on these, value fluctuations that may occur. So the share market goes up, that would be included as an unrealized gain, drops down, that is an unrealized loss. So we're now looking at a taxing regime that is looking at that particular type of earning. Now, the tax payable of 15%, but it's not on all of it, it's on a proportion. And I've underlined this as well, because this is a really important fact in this, is that it's the proportion of the fund that exceeds $3 million. So it's not the whole fund, it's not the whole amount over $3 million, it's as a proportion. And when we work through some of the examples, you'll see that proportion is really important, because the lower you are over $3 million, the less tax you pay. The higher the balance, the greater proportion, the bigger that tax number will look for you. So we'll work through an example on that just to really drill that in. But if you're just over the 3 mil, your proportion will be very small. There is no indexation. So that's the second thing that we hate about this tax more than anything else, is that there's no ability in there, for it to just automatically increase over time. There is a lot of research being done as to, well, what does that look like long term? One of my staff modeled his own situation and said, well, he would be impacted by this, even as someone who's just, making, regular employer super contributions. So there's no ability in there at the moment for that to be indexed. Now, I've been obsessing over the media commentary on this. It's a fascinating insight into people's thinking. And there are a lot of people that simply say, well, the government will just change that. And of course they can. But the concern is there's no, automatic measure for this to be reviewed on a regular basis. And as inflation, creeps in, that is a concern for people to say, well, we actually have to actively wait for someone to change the legislation to index it. The other question that I get a lot is, well, what happens if the market goes down? Do I get a refund, for any losses that may occur? Your losses are carried forward. So if your earnings number is negative and that number goes down, you don't get a refund for that downturn, but you get a credit or a loss that then offsets future income gains. So if you've got investments that are doing this and they're, really up and down, you get that carried forward loss that will help you, that will help offset that gain. So you'll be in this cycle, of that. So there's no refund, but it is important to note that that loss is not gone. It is there carried forward for you to use for the future. So what is our current state of play? Okay. Now, as I say, this has been around for quite a long amount of time. So this was announced in February 2023. It came out as like this little, 5 or 6 page document that read quite, okay, yes, we're going to have this extra tax. It's going to be for balances over $3 million. But this is where they, put in one little line what this new definition of earnings was. The legislation was drafted. It did pass the House of Representatives. There was a bit of conversation there, but it did get through there. It was sent for a Senate review. So it was sent to a Senate committee where they said, look at this, make sure that this is okay. Came back, no issues. They said, no, we think this tax is completely fair. We don't see any issues with how this is drafted. It then, however, got stuck in the Senate. And it sat in the Senate for quite a long amount of time. So what that meant was that there was a couple of people that said, we've got issues. And we've got issues with two main things, which is the things that most of us have issue with, which is that it is on unrealized gains and that it is not indexed. So it got stuck there. Again, I followed the last few sittings of Parliament quite obsessively, where this piece of legislation was really, tried to be tacked on, or they were really trying to push this one through. It did not get through. So then when the election was called, the legislation lapsed. Now, We then had the election result that I don't think a lot of us were really expecting to see. And all of a sudden, this legislation has popped right back in with a steaming, forward momentum. The government has confirmed on many occasions that they do intend to proceed with this legislation as it is, and they do intend to, push forward. Jim Chalmers has said, that this is not new. It's been around. We've all seen the legislation. They were very clear that they intended to push forward with this legislation, so they don't intend to delay that 1 July 2025 start date that was previously announced. However, it is still not passed into law. Okay, and we're not going to see it passed into law until after 30 June 2025. So we're still stuck in this little bit of, yes, they've committed to it. They have the numbers to get it through with the Greens' support. Now, the Greens would actually like changes to this. They would like that number, rather than it be a tax on balances over $3 million, they would like it to be over $2 million. But they also are happy for it to be indexed. They've also put in other things they would like to see, which is no more limited recourse borrowing arrangements inside of super. The government's been pretty clear that they don't, really support either of those changes. I will actually just say very interestingly, I did see some research that said that under the Greens measure, where it starts at $2 million but is indexed, while there are more people captured in the short term, in the long term, there's actually less people captured overall because of the impact of indexation. So if you had questions about does that indexation really matter, the research is starting to show it actually really does. So that's where we're at the moment. So what are the finer details of things that you need to know? Now, the first of this is a personal tax. And I really want to make it clear that while we talk about, there's now a 30% tax on super, I've seen that a lot in media, that's not the case. This is a personal tax. It is entirely separate from your superannuation taxes. So, it's really important to note this is its own little tax, okay? It is your super fund will still have its own tax regime, but this is a personal tax for you to pay. It can be paid for by your superannuation. So similar to the Division 293 tax, which is the tax on contributions for higher income earners, so where you have to pay that little bit extra, it's very similar to that. So it's a similar, that's a similar process it will go through. The superannuation funds all lodge their tax returns and their member statements to the tax office. They do the calculation, they send you the bill. They say you can pay this from super as long as you go through this release process, or you pay it personally. Okay, so it is not a super fund tax, it is a personal tax. So that means that things like your existing tax refunds, or any capital losses and things you might have in your superannuation fund don't apply to this tax at all. There's, if you're getting a franking credit refund, but you're getting a tax bill under this, they're two separate things. One doesn't offset the other automatically. So I just really want to reinforce that to people because it is talked about like it's a super tax. So as I say, at this stage, it is due to commence on 1 July 2025. And when I say that, it means that that is the first date that we'll start looking at member balances. So the tax doesn't start on that date. That's the first date that we start looking at these member balances. And then the first tax bills are going to be paid after lodgement of the 2026 return. So we're looking at about the 26-27 years where the cash is going to actually have to start to be paid. So step one, what are the things that we need to start looking at? Question one is, does this apply to me? Okay, so first off, for those that are online maybe thinking about it, does it apply? You need to understand and check what your total super balance is, okay? So your TSB. Now, your total superannuation balance is the value of all of your superannuation accounts. So that includes any pensions, accumulation accounts, if you've got an old defined benefit, if you've got some little, a super account that's been sitting over, in a retail fund that you've not really bothered to do anything with because it's annoying to try and deal with it. All of those balances are added up to tell you what your total super balance is. Now, this is a moving number, so it's not a set and forget. So you can't just sort of look at it one year and go, oh yeah, okay, that's this number, it doesn't apply, or that's this number, it does. Obviously, it fluctuates every year with balances, so you need to keep an eye on this. This can be found on your MyGov. If you have that, that's where the ATO is pushing everyone to get all of their data and information. If you can't find it or you don't have your MyGov set up, or you're not really certain about it, your tax agent and accountant can have a look at that for you as well. It is based on the information that all of the funds report to the tax office though, so it is always worth checking, and if you're not certain that it is correct, making sure that you're checking with your superannuation funds directly as to say, is this number correct? And is this, am I relying on the right information? Now, the tax applies if your total super balance is more than $3 million on 30 June, and that is checked every single year. So you can fall in and out of this system as your balance fluctuates. So the first test date where they say, are you in the system, is 30 June 2026. Okay, but as I say, just because you're not over 3 million on 1 July 2025 doesn't mean that asset values aren't going to increase and you're not going to fall into the system on 30 June 2026. Okay, the other thing though is to just understand it doesn't apply under and over $3 million. And what I mean by that is let's say that you start the year at $2.5 million and you end the year at $3.5 million. You've had an amazing year in investments, you've made $1 million. They don't count that movement from 2.5 to 3.5. They only start counting at 3. So that is a good thing. They're not looking at, if you have an absolute, cropper of a year and things go amazingly well, they only start counting that earnings number at $3 million. Okay. And same thing, if you drop down, they don't keep counting you as you fall out of the system. So really important first thing is to understand, are you going to be impacted by this tax? The second thing is, well, what is this earnings number? You guys keep talking about unrealized gains. What does this actually mean? Now, when we're looking at earnings, it's a really simple calculation, and they did that on purpose. Okay, this method wasn't created, to specifically detriment people. What they did is they went to superannuation funds, and Treasury went to our retail and industry fund friends, who said, well, this is how we measure it. And this is how it does work. If you have a retail super fund, they say, how much did you earn? Well, it's your closing balance. So what did you finish with? Minus your opening balance, add back in any withdrawals that you took out, take out contributions, and that's how much you've earned. So that is how it already works in retail land. However, with self-managed super, of course, we know exactly how much you've earned. So that's where we get a little bit frustrated by this. But that is the calculation. It is simplicity. They're trying to keep it simple. So this is what we've ended up with. So let's, how does that actually play out? Here's just a really simple example for you. So someone's got a balance of $3.7 million on 1 July 2025. They make a $220,000 downsizer contribution. Okay, so that's a contribution, so that gets taken out. And they had an $80,000 pension withdrawal, so that gets added back in. So they end the year with a balance of $4,640,000. So the earnings calculation is right there, 4.64 million, so closing balance minus opening balance, 3.7 million, add back our pension of 80, take off our contribution of 220. The earnings amount, according to this, is $800,000. Okay, so that is the calculation that we do when we're trying to determine what is actually your earnings. Okay, the third thing that we do when we're trying to calculate this is what is the proportion and then what is the tax bill? And so that proportion number is really, really important. The higher your balance over the $3 million cap, the higher the tax you will pay. Okay, and I don't mean that you pay tax at a higher rate. Okay, what that means though is that the proportion that applies is much higher. If you're only just over that $3 million cap, the tax bill may actually be quite small. All right, so let's look at the same example that we had before. The proportion, so this is how we calculate the proportion. It's the closing total super balance, okay, less the $3 million cap. So they say how much of your balance is over $3 million, and then what's that as a proportion of your total balance. All right, so in this case, it's 4.64 million less the 3 million. So of the total balance that this individual has, they've got $1.64 million over that cap. So as a proportion to their total super balance, 35% of their superannuation is over this cap. Okay, so that's that proportion calculation. So, if we think that balance was lower, then the tax number will be quite different. The tax calculation is then as simple as earnings times proportion times 15%. So in this example, with this person that has had $800,000 of earnings, Okay, with a 35% proportion, their tax bill would be just over $42,000. Okay, so that's the calculation. Let's say that we bring those numbers down, make them a little bit, different, and let's, so we can really see the impact of that proportion. Let's say that instead of their total super balance closing being that $4.64 million, it's only $3.8 million. Following the same process and the same calculation, the tax bill drops to $25,000. So as I said, you can see the impact that that proportion number has. And that's going to be really important moving forwards, because it's going to be, if people are saying they want to not pay this tax at all, it will be quite difficult because obviously there's market value fluctuations that need to be considered in all of that. I can see questions popping into that chat like crazy. Thank you everyone for your questions. Thank you to my team who are hopefully answering them. And hopefully I'm going to have enough time to address them at the end. But that is how that tax calculation works. Okay, now that is something that we will be working on, working through with people as to go, how does that tax look for you so that you can get a real understanding of what your tax bill might be. Now, a question that I had specifically reached out to me during the week to say, can you please cover off on losses? Of course, John, this one is for you. If the earnings number is negative, then that amount is carried forward to be used against future earnings. Okay, so there's no refund or anything like that, but it does then, it's used up by any future earnings. So what I've done in this one, so using our same calculation, let's look at how the impact of that might have been. So let's say we've paid that tax in year one. We had a really great year. We had an earnings number of $800,000. We paid our tax bill of $42,000. In year two, however, one share price, so we were heavily weighted in one share, that share price dropped. Okay. Oh, Lauren, you've put your hand up.
Yeah. Can you hear me?
Yes.
I think you need to, we're seeing the slide that says the finer detail step 2.
Oh, I'm so sorry, everyone.
Slide 10. We're just getting a few questions about that.
All right, hang on, let me go back. This will probably make a lot more sense to people then. Thank you, Lauren. Okay, so look, I might just leave this slide here a little bit for people. We are happy to also circulate the slides as well. I can't believe I've done that again. I did that last time I did this presentation too, and no one understood what my calculations were. So look, I'll just recap that now that you can see, so that all, you can see what I'm talking about and not just my hands. So as I say, so in that, calculation, when we were doing that tax calculation, what we can see there is the proportion, so that calculation. So we were $1.64 million over the $3 million cap. That gave us a proportion of 35%, and our tax therefore was the $800,000 by the 35%. By the 15% tax rate was $42,000. When we made that proportion smaller, we could see there, that the tax bill dropped from 42,000 down to 25,000. So the earnings number was the same in both examples, okay? But what happened was that our balance, or the amount that we were over, was less, so therefore we paid less tax. Hopefully that makes a little bit more sense to people as we continue. And I'm going to click on it instead of using arrows to make sure I've got the right one. Okay, so if we do look at losses now, as I said there, so look, using our same example, we paid our $42,000 tax in year one because things went up. We're now in year two. We've had one share price that we were overly weighted in that has dropped. The balance fell to be $4.2 million. Okay, so we went from 4.64 down to 4.2. We've now got a carried forward loss of $440,000. Okay, now I've ignored the impact of contributions. We're saying there was no contributions and no pensions in this year, so we've not had to make any adjustments. But so our negative that we carry forward is $440,000. Let's say then that over the next couple of years, things just stay pretty steady. We're just making just under 5% each year. So in year three, our total super balance increases to 4.4 million. So we follow the same calculation. What is our earnings? 4.4 minus 4.2, our earnings is $200,000. However, we had a loss of 440,000. So our earnings now is a negative still of 240,000. We carry that forward to year three. Same process, $200,000 gain, reduces our loss carried forward loss of $40,000. In year 5, that share, she's come good again. We've bounced straight back up. Okay, we've increased our balance back up to that $5.8 million. Okay, we use up what's left of our little loss, but same calculation, closing total super balance minus opening, take off the loss that we've got carried forward. We've now got an earnings number back up to that 1.16 million. So that is how the losses apply in this situation. So what are the key questions that you need to ask while you're thinking about what do I do? So you've gone through step 1, I am impacted. Great. Now what do I do? What you need to look at is, well, what is the mix of this earnings that makes up this number? How much of it comes from income? And so by income, I mean dividends, bank interest, rent, whatever it is that makes up your, superannuation income. How much comes from income and how much comes from market movements? So this unrealized gains, which seems to be the big issue that we all have. Why does this matter? Okay, why does it matter what proportions you have? Well, because tax rates inside of super on income, they're actually still pretty good. Okay, it is still an incredibly concessionally taxed environment. Even if you are over, the $3 million cap, the superannuation fund income tax regime, let's say, even if you're not in pension phase, you're not paying any more than 15% tax. So that is an incredibly tax effective place to hold investments when you're looking at tax on income. Capital gains tax inside of super is also, and I've said it's not just pretty good, it is excellent, okay? Because there's a maximum of 10% of capital gains tax if the asset's held for more than 12 months. That is far less than what you can get outside of any superannuation structuring. So the reason why we need to think about that is that if you've got income that is generated, or earnings, I should say, that is generated mostly from income, your superannuation fund may still be a more tax effective vehicle to hold it. If, however, you've got speculative investments or things that have values that do fluctuate or things where we might see a big increase in value, that is where this tax might be more punitive than having the assets inside of super versus outside. So as you can see, there's no simple answer to which tax is better, because you have to be applying apples with apples, and you really need to make sure that you're considering the income tax, because if you take the assets out of super and pop them into another entity, what tax rate do they pay on this? So you really need to make sure that you're weighing these things up because it's the unrealized gains tax that is the painful one. The second question that you need to ask yourself as part of this is, what are the costs to transfer out? So we've had quite a lot of people, immediately their response is, let's just take the assets out of super. Let's get ourselves down to be less than that $3 million so I don't have to worry. What we need to think about is, well, what is the cost to get those assets out of super? So let's assume that you are eligible to be withdrawing assets from superannuation. You're over 65 or you're retired and you're able to take assets out. Even though there may be no tax payable by you on that asset withdrawal, any transfer in asset is still a capital gains tax event within the superannuation fund itself. So you are actually going to be triggering an upfront cost to get that asset out, and that absolutely needs to be brought in as a consideration. If you have lots of assets sitting in cash, term deposits, and you're just saying, I'm just going to transfer it out, great. No, you don't have any cost to sell assets out because it's cash. There's no capital gains tax. But if it is an asset, you're going to have capital gains tax implications, possibly transfer duty as well. And one thing that, that the modeling that we've started to do is, well, what is the upfront cost and how many years had you had it in super, does it take to recover that upfront cost, that of a cost that we didn't have already. So I'm just going to give you a quick example. Now I'm going to apologize in advance because this gets into some accountant things that maybe people are going to say it goes over their head. So I'm going to try and stick to some principles that hopefully will make sense to you as we do this. But don't feel bad if you think I lose you at one point. So let's look at a fund. Let's say it has a total super balance of $5.5 million. Okay, part of this is a property that's valued at $3 million. okay, with a cost base of 1.2. So what that means is that we bought the asset for $1.2 million. It's now worth 3. So if we choose to transfer the asset out of super, that's the market value. That's our sale price, even though we're just transferring it out. So you can see there that we've got a capital gain already if we choose to do something. Now, this particular member, so again, I've tried to keep this as realistic a scenario. They have a pension balance, okay? So they have a balance. They started their pension last year, and it's worth $2 million now, and everything else in their super fund is sitting in the accumulation balance, okay, of $3.5 million. So why that is important is that the assets that are supporting a pension, you don't pay any income tax on those, but you pay income tax inside the super fund on the amounts that are in accumulation. So what this means is that not all of this super fund is tax-free. Part of the super fund is going to be paying income tax on any capital gain. Now, this individual says, I don't want to be in this tax regime. I don't like it. I think this property is going to go up in value in future. I would rather just get out of this. So they decide to transfer the $3 million property to themselves. So $3 million comes out. That leaves them with $2.5 million. They would fall outside of Division 296 tax. But what's the cost to get that asset out of super? I've left transfer duty or stamp duty out of this because it varies from state to state. And I know some states do charge you transfer duty on that. So if you do need to think about that cost as well if you're in one of those states with a duty regime that will charge you stamp duty on that as well. So the calculation for this, and again, don't get too bogged down if you don't understand what I'm doing, but the capital gain is in effect $3 million minus $1.2 million. So our capital gain is $1.8 million. Okay, we're entitled to a 1/3 discount. I've done that by reducing my super tax rate from 15% to 10%. So our tax bill on transferring this asset out of super is $1.8 million at the 10% tax rate, and 36% of our super fund is tax-free. So that $2 million we've got, we don't pay any tax on that, but we pay tax on the rest. So 64% of our fund is taxable. We'd have a tax bill on choosing to avoid this. Sorry, I shouldn't say avoid, to restructure our assets, okay, our tax bill on that would be $115,000. So when we're thinking about, is it a good idea to try and restructure so to, minimize the impact of this tax, we are going to be hit with that tax up front, and we need to weigh up, is that a cost we're happy to bear, or actually our tax bill over a number of years will only be $10,000. It'll actually take us 15 years to have to pay that tax. So that is a really big decision that needs to be made when you're looking at, restructuring or making any decisions. The third key thing to consider is if it's outside of super, what do you do with it? Okay, so long-term capital gains is worse outside of super. As I said, a capital gain, the maximum tax rate you pay inside of super is 10%. Outside of super, the very best I think someone can do for you is 22.5. I don't work in personal tax. 22.5 as the very best scenario that someone could do for you. So what are your plans for this asset? Is it long-term it's going to be sold? Is it long-term it's going to be passed to the next generation? These are the things that need to be considered because, holding it outside of super may give you a very big capital gains tax bill in 15 years' time. So as I've said there's a lot of crystal ball gazing in this, and at some point you do need to make a call about what is best at that particular point in time. But these are some things to think about. Is this an asset that you're going to sell in 5, 10, 15 years? What's the impact of paying Division 296 tax along the way versus the capital gains tax bill that'll be waiting for you at the end? What structure do these assets sit in? Is it a trust? Is it a company? What is the best vehicle for you to have these assets in? Is it part of an intergenerational wealth transfer where you start to think, all right, the time has come, maybe I should start passing this down to the next generation? That opens up a whole new conversation around what are the tax implications outside of super as well. So hopefully what you're seeing from this is there's no simple answer as to what should you do. Because even if the simple response, your instinctual response is, I'm just going to cash it out of super, there's actually some other things that need to be factored in as well before you just make that decision. And it does need to be very carefully planned. What else needs to be considered? This is one, and there's a whole other webinar on superannuation and death benefits because that's a very big topic. But one thing that I will just flag is the difference. And when you're looking at your superannuation fund estate planning and maybe how your pensions are structured, there is a difference between what is called a reversionary pension and a death benefit pension. Now, a reversionary pension is traditionally what was considered to be, the best of these, which is, it's exactly what it sounds like. On your passing, that pension automatically reverts across to your surviving spouse. Okay, so you say, I definitely want this to go to my spouse, and on my date of death, it just automatically passes along to them. It's the most seamless way to do it. No one's having to make a decision. It does ease a lot of pressure during that time. A death benefit pension is different, okay? A death benefit pension is one where the surviving spouse might say, okay, I'm due to receive these benefits. I'm actually going to choose to take a pension with this. And it's a conscious choice that is made at a later date in time. Now, why is this important, Katie? Why do we care? Let's think about two members with $2 million each. At the moment, nobody is impacted by this tax at all. Okay, we're well under the $3 million. Everyone's happy. You've probably already switched off from the webinar. You're thinking, I don't need to worry about this. If something happens to one of these members and it is a reversionary pension, on date of death, that person's balance automatically rolls over to the next person. Now, while that receipt of balance does not it count in any earnings, I mean, that would be ludicrous. We don't have that, but actually now someone has $4 million, which means they're automatically going to be in the system for anything else that has happened during the year for the next year. So there's no timing choice. Whereas if it's a death benefit pension, the surviving member has the ability to choose when they elect that death benefit pension within reason. It does have to be as soon as is practicable. But if someone passes away in May, that decision may not practically actually be made until August. So that means that on 1 July of the year, maybe we have time to think about how we're going to structure this instead of automatically being whacked into this new tax regime. So it is an extra thing to start thinking about, and probably not for you guys to think about. It's for your financial advisors and things to start thinking about longer term. Do we need to restructure our death benefits? I do also just, flag in there that death benefits tax on superannuation still does exist. That's not gone away. So that should be considered in any decisions we're making about taking assets out of super, because, if we've got a big potential death benefits tax problem, maybe we want to start thinking about taking the assets out anyway, regardless of this tax. I will also say that the timing of when assets are removed, and by timing I mean literally the month that you take it out in, can make a big difference from that capital gains tax as to whether it's better or worse. So the planning of this is essential. So I'll reiterate, I think, which is one of the first things I said, which is don't panic, because there's a lot of impact of timing that can make a big difference on the tax bills that you pay as well. I don't want to get too bogged down in that. So where to from here? Again, don't panic, okay? We had a lot of people really stressing about, how does this impact me? What do I do? Someone said, I've got my cash ready. I'm ready to go. Tell me when to go. We say nobody panic, because everybody's circumstance is different. There's no immediate right or wrong answer. Everyone needs to think about all of those things that I put forward, and then also some things that are your personal circumstances. So which date is important as well? Is it 30 June 2025? Do we need to be under on that date? Or do we try and consider things over a 12-month period, make decisions, and be ready for a 30 June 2026? Okay, because there can be, as I say, the timing of when assets come out can have an impact on that capital gains tax. Maybe you pay less capital gains tax and a little bit more Div 296 tax in year one. There's a whole range of different factors that need to come into play. We are building some modelling, so we have a wonderful team that is much better at spreadsheets than I am, that are looking to build us some specific modelling around this so that we can punch in different scenarios and kind of get some ideas around taxes in, taxes out. What does it all look like? What happens if you change that mix between income and capital growth? What impact does that have if you change your investment mix? So we're working on that. They are building as frantically as they possibly can, but it is quite a complex situation. As soon as we have that ready to go, we'll confirm. If you are an RSM client, please contact your local super specialist or financial advisor. They will be able to guide you, answer any questions that you might have for your specific circumstances. I certainly know that at the moment, what I'm doing with people is asking those questions. What are the costs? What are all these things? Let's have a think about this, and let's really think about what is best for your circumstance. And if you are not an RSM client, because I know this went pretty wide, and you would like some assistance, please reach out. I've left out and out. Please do reach out to one of our experts who would be more than happy to talk you through this, and hopefully address any questions that you might have. Now, I think I've got 3 minutes left, which I'm going to now jump into our questions. I can see that Lauren has been doing an exceptional job in addressing these. So let me just jump into the questions that I currently have. Okay, so we've got a question here about, will they backdate assets to 30 June 2025? So look, that is what they're looking at doing is, yes, that will be the test date that they will look at. What is the balance at that date in time? That is all indications we've got. I preface all of this with we don't know, we're still dealing in a situation where we don't have actual legislation. We don't even have a government that is sitting yet. So we're really operating on the basis of decisions by media release as much as anything else. So just be conscious of that. Will you be able to access a copy of the slides? Yes, I think we're more than happy to circulate the recording and the slides as we go. My goodness me, we've got a lot of questions here. How will overseas corporates who have bought farmland in Australia and are funded by super funds domiciled in their country be treated? Will it be different to family-owned farms who own land in their SMSF? Richard, I'm going to answer what I think that is. This is a tax for Australian superannuation funds only, not for any foreign superannuation. So if assets are bought in Australia, whether it's in a self-managed super fund or a retail or industry super fund, they will be subjected to this tax. But if the assets are owned outside, they are not part of the Australian tax system and would not have to worry about that. Okay, we had someone ask a question about the practicalities of determining closing balances, so paying for property market valuations. Yeah, this is actually a really interesting issue that I think is going to have a problem. Now, theoretically, superannuation funds are required to value their assets every single year. That is actually a requirement already. The Commissioner does ask for a certain amount of information and evidence to support that. So that has not changed. Where I do think this is going to, because now value is going to become so important, there may be more of a driver to invest in better quality valuations, more information to help support the balances, that you are reporting. And as we know, it is really hard to get valuers to do things at the moment. There's just not enough of them, and to do them in a timely fashion. So I do think that's going to lead to some sort of an impact as well. And also the question there about what does that mean for shares held in private companies and values? Absolutely a real concern. There are superannuation funds that do have, assets in investments that are not easy to be valued. So there may be more of a requirement to get formal valuations on those. As same as for someone who's asked a question about unlisted international companies, same thing. The pressure on the quality of those valuations is going to become really important, because the auditor reports to the Commissioner if they don't think that your values are correct. The Commissioner does data matching, to see has your value changed year on year? They're already doing that. So there's going to be a lot of pressure on auditors and a lot of pressure on tax agents and, things around that. I'm just going to do 2 more because I'm already at the end. of my time. What happens if your SMSF does not have cash flow to pay the following tax? You would need to enter into a payment arrangement with, sorry, so just to clarify, it's not the SMSF that has to pay the tax. It is a personal tax liability, and the individual would need to enter into a payment arrangement with the Commissioner to pay that tax if they did not have assets outside of super to pay it. The super fund can pay it, but is not obligated to. And I'm actually going to answer this one because someone's asked the question about the hysterical emotion being expressed in the media about this, fairly unfounded, given that the $3 million won't affect a lot of people. And why do I think there's so much concern in the media? And I'm going to finish on this one actually, because it's something I feel quite strongly about. I think we have an incredibly concessional superannuation tax system. And I think most of the people who are actually going to be impacted by this tax, a lot of them, I'm not going to speak for everyone, but a lot of them say, do you know what? We do acknowledge that we've had an amazing concessional tax run over the years, and we probably can afford to pay some more tax. Why there is a problem with this, and why and I'm one of those, I think we do have a concessionally taxed, tax environment for superannuation. The balances that we have in there, we're not going to see again, in the next generation because of the changes we've had previously. So this is a timing issue. All of the hoo-ha about the $100 million funds, that's not going to be a problem, in 15 years because we've got a whole range of other measures that are going to deal with that. But why is there so much concern in the media? My biggest concern with this is this taxing of unrealised gains. I think it's a fundamental difference in the Australian tax system to start taxing people on income, on returns that they have not earned. I don't, I've seen some commentary this morning about you pay rates on an unrealised gain. I think that's probably a different regime that we're talking about here. What we're talking about is starting to tax people on an asset value that may not actually be real. An unrealized gain is exactly that. It is not a real gain. It is an arbitrary valuation at a particular point in time, and having people pay tax on that is just not the fairest basis that this could have been done. The fact that we have the ability for the tax to be paid on actual income would mean that this tax was actually fairly applied on real money that people have actually made. Death benefits tax is still in place when people pass away, so there's a tax capture at that point. Capital gains tax is still in play. There's a tax capture at that point. There is the ability to make this a much fairer tax than having to do something by applying a really broad brush that applies more for simplicity and administration than it does fairness and equity. And I'm going to get off my high horse now about that one. Thank you to the person that asked that question. It wasn't even a plant. But look, I've gone over time already. We hope you have gotten something out of this webinar. We will make sure that we do circulate the recordings. There is going to be a little poll at the end to see how you found the webinar. If you could please give us some feedback, that would be wonderful. We would love to hear from you. If you are one of our clients and you are really concerned, please do reach out to us. We're more than happy to talk to you and to address your specific concerns. Otherwise, we hope that you've enjoyed the webinar and that you enjoy our webinars in the future. Thank you very much.